Buying a business sounds like a shortcut. Skip the years of trial and error, skip the "will anyone actually pay for this" phase, and just take over something that already makes money. Here's the myth-busting part. Most people who try this don't buy a business. They buy a job. A stressful one, with debt attached. Let's put real numbers on the table right away. In 2025, the median small business in America sold for roughly $350,000, up 2% from the previous year, with businesses typically selling at about 94% of their asking price. Median cash flow on those businesses was around $159,000 a year. So if you're picturing a $20,000 side hustle purchase that spins off six figures a month, that's not what this market looks like. It's a real financial commitment, with real financing rules and real risk. Is it profitable? Often, yes. Is it a shortcut? Rarely. Stick around, because I'm going to break down exactly what it costs, where the money goes, and who this actually makes sense for. Biz buy sell, biz buy sell. This video is for people with some capital saved, decent credit, and a willingness to run day-to-day operations, not silent investors looking for passive income. If you have zero savings, poor credit, or you're hoping to buy a business and immediately hand it off to someone else to run while you collect checks, this is probably not your move yet. Buying a business is operational work on day one. You inherit the good and the bad, existing staff, existing customers, existing headaches. So what does buying a business actually mean? Instead of starting from zero, you're purchasing an existing operating company, its customer base, its equipment, its brand, sometimes its real estate, and its cash flow. You make money the same way the previous owner did, by running operations and keeping the profit. The difference is you're paying up front, usually through a mix of cash and financing, for the right to step into an income stream that already exists, instead of spending years building one from scratch. Now let's talk demand. The business for sale market in the U.S. is active and growing steadier, not explosive. In 2025, just under 9,600 small businesses changed hands on Biz Buy Sell alone, with total enterprise value reaching $7.95 billion. Service businesses lead the pack, the largest category at 42% of all transactions, and buyer demand is especially strong in home services like HVAC, plumbing, electrical, and landscaping, where brokers report hundreds of active buyers chasing too few listings. That tells you something important. The more boring and essential the business, the more competition you'll face to buy it. Biz Buy Sell +2. Let's break down the minimum capital you actually need. Cost category minimum estimate equity injection / down payment, 10% of purchase price on a $150,000 to $350,000 deal, $15,000, $35,000, due diligence, accountant, business valuation review, $2, $500, $6,000 legal fees, purchase agreement, contracts, entity setup, $3,000, $8,000 SBA loan closing costs and fees, $2,000, $5,000 working capital reserve, payroll, rent, bills for first 60 to 90 days, $10,000, $25,000 software / CRM transition if systems need replacing, $500, $3,000 marketing / rebranding transition, $1,000, $3,000 miscellaneous / contingency, $2,000, $5,000 total minimum investment, $36,000, $85,000. That range assumes you're financing the bulk of the purchase through an SBA 7A loan, which is how most small business acquisitions in the U.S. get funded. Here's why. For most SBA 7A loans, lenders require a minimum equity injection of around 10% of the total project cost when acquiring an existing business, since the SBA views acquisitions as higher-risk deals tied to management transition and customer retention. So if you're buying a $300,000 business, you might only need $30,000 in cash, not the full purchase price. Crestmont Capital. Let's talk about where that money actually goes. The equity injection is your skin in the game. The bank won't fund 100% of the deal. They want proof you'll fight to make it work. Due diligence and legal fees protect you from buying a business with hidden debts, fake revenue numbers, or contracts that don't transfer. Skip this step to save a few $1,000s, and you can lose the entire investment. Closing costs are the lender's fees for underwriting the SBA loan. Working capital is the part beginners underestimate most. You need cash to cover payroll and rent while you learn the business, because revenue doesn't pause for your learning curve, but bills don't either. Monthly operating costs after you take over depend entirely on the business, but budget for loan repayment, payroll, rent, insurance, and existing vendor contracts, typically the same operating cost structure the previous owner had, plus your loan payment on top. On income potential, be conservative here, because inflated promises are exactly what get first-time buyers into trouble. A conservative estimate, in the first year, is breaking roughly even after loan payments while you stabilize operations. A realistic estimate, assuming the business was healthy and you don't lose key customers, is $40,000 to $70,000 in owner profit in year one, on top of your loan payments. An optimistic estimate, if you grow the business and cut inefficiencies, is $80,000 plus. Industry estimates suggest average profit margins for small owner-operated businesses land around 30% for well-run service businesses, though this varies widely by sector. Biz buy sell. Break even on the acquisition itself, meaning recovering your cash injection, typically takes 12 to 24 months if the business performs as advertised. That's the optimistic case. Add 6 to 12 months if there's a rocky transition. The biggest mistakes people make: skipping professional due diligence to save money, underestimating working capital, and running out of cash in month 2, assuming the seller's numbers are accurate without verification, and, this one's underrated, not talking to existing employees and customers before closing to gauge whether the business survives the ownership change. Where's the opportunity? Most buyers chase the same listings: restaurants, retail shops, anything glamorous. The underserved niche is unglamorous, recurring revenue service businesses, HVAC, plumbing, cleaning, landscaping, laundromats. Less competition for buyers who don't mind blue-collar operations, and these businesses often carry higher valuation multiples specifically because they require less hands-on labor per dollar of revenue. Your differentiation as a new owner isn't reinventing the business, it's usually modernizing the boring parts. Better scheduling, online booking, faster follow-up, and cleaner books. Biz buy sell. Here's the step-by-step. 1. Get pre-qualified for an SBA 7A loan so you know your real budget before you shop. 2. Identify your target industry and search listings on marketplaces like Biz buy sell. 3. Request financials on businesses that interest you and run the numbers yourself. 4. Hire a CPA and attorney for due diligence before you sign anything binding. 5. Negotiate price based on verified SDE, not the seller's asking number. 6. Close the deal and plan a 90-day transition period where you shadow operations before making major changes. On tools, most small businesses you acquire will already have some system in place, often an outdated one. This is where owners lose time, manually tracking bookings, invoices, or customer follow-up in spreadsheets instead of a proper CRM. Modernizing that layer early usually pays for itself fast in saved hours and fewer missed leads. If you need to rebuild or upgrade the website, CRM, or booking system after your acquisition, SoftAngles can handle that implementation for you. You can book a free consultation and estimate through the link in the description. To be clear, SoftAngles helps with the technical build, website, CRM, software, not the acquisition or business plan itself. Marketing after acquisition is mostly about retention, not reach. Online, claim and clean up Google Business Profile, fix broken websites, set up review requests. Offline, keep existing referral relationships alive, call your top 10 customers personally in week 1. Low budget strategy, focus entirely on reactivating dormant customers before spending on new leads. Scaling strategy, once retention is stable, layer in local SEO and paid ads to grow beyond the previous owner's ceiling. Risks are real. Financing falls through. Key employees quit after the sale. Customers were loyal to the old owner, not the business. Hidden liabilities surface post-close. And integration takes longer than planned, almost always. Do verify every number independently, budget extra working capital, keep the existing team informed early. Don't skip legal review to close faster, assume you can run it exactly like the seller did, or drain your cash reserves on rebranding in month 1. Final verdict: buying a business is worth it if you have capital, patience, and you're prepared to operate, not just own. It rewards people who can run a business, not just people who can pay for one. Skip it if you're looking for passive income or you can't stomach 6 figures of debt tied to your name. If this helped you think clearer about buying versus building a business, subscribe for more breakdowns like this one. And if you need help setting up the systems behind your next business, book a free consultation with Soft Angles through the link below.